Good morning, traders. Today is Wednesday, January 25th. My name is Charles, and this is the Pirate Traders live stream. All right, well, let's take a look at the charts and see what we've got going on this morning. Well, the market is going to open with a gap down. A gap down increases the odds that the first move that the market will try to make is a move up to try to fill that gap, okay? But it's important to remember that that move will not be bullish because the gap down tells us there is momentum to the downside. Yesterday's range didn't really give us much of a clue of anything. It just rotated inside the previous day's range, keeping value inside the previous day's value, and we closed pretty much, right in that range where we'd spent all the time and brought in all the volume. So at the end of the day yesterday, really the only potential information we had was the look above and fail of the balance area, which we talked about, okay? But we didn't know. Well, now the overnight is giving us new information, okay? And that new information is bearish. First off, they spent most of their time and brought in most of their volume below where we did it yesterday, which was below the previous night, which was below the previous day. So we can see the momentum is down. Okay, more time, more volume at lower prices. Then we have the gap. The gap is also a sign of momentum down. So before we can even consider getting bullish in any way, shape, or form, we would want to see the market push all the way back up to yesterday's low at 4,005 and then back up into yesterday's range. Then we can start to get bullish or really neutral. But as long as we are below yesterday's low, we are bearish because of the gap down. The gap down in combination with the look above and fail of the balance area significantly increases the odds that the market is trying to head to the opposite end of balance. Once again, right? Pew, pew, pew. What do you think comes next? Pew. Now, I'm here on the daily chart just to point out we are also back testing that downtrend. So remember, couldn't get through the downtrend, got through it, couldn't stay above it, got through it and stayed above it, couldn't hold on the back test, got through it, stayed above it, now we're about to back test it again. So if they find support right around the overnight lows, they could turn around and take the market higher. But before they're going to do that, they're going to get back in yesterday's range. So we stay bearish, assuming they're heading down towards that 39.20 area, the balance area low, until we get back up in yesterday's range, because that is the highest probability. All right. First order of business, can the market fill the gap? Can they get back up to 4,005? If not, it's a gap and go. Let's see what they got. Okay, the A period high is weak, increasing the odds. They still want to try to fill that gap. Okay, overnight inventory, obviously net short with the fact that the market pushed lower. So there's a lot of overnight inventory that needs to rebalance. Also increasing the odds that they'll try to fill that gap. If they can turn the overnight low into resistance and hold the market here without passing back through the opening price, that would be very bearish, but less likely in my opinion. All right, once again, testing the overnight low as resistance right here. Still lots of inventory that needs to be balanced off. Mike, so for the market to have closed down here in the overnight, most of the traders had to be short, correct? The price goes down when there's more sellers than buyers. Okay? So we know when the ticks open all the way down here that the market is very, very oversold. So the first question we have to ask ourselves is, who are all these sellers? The second the market opens, well, that's those overnight sellers, right? Who push the market down. And so now, as we watch those ticks come back up towards the zero line, that's those sellers taking profits down here. And so we're watching the low to see, do new sellers pile on here and take it lower? Do we get resistance, and do those ticks get smacked back down? Until we see that, the assumption is they're going to try to fill the gap, because there's just still more traders that need to take profits. So the ticks will tell us, can they work their way back up to the zero line, or do they get smacked back down again? To smack or not to smack? That is the question. So we can see, we're talking about this example, they're holding price at the overnight low while the ticks are moving up. So those overnight sellers are taking profits, but the price isn't going up. So what does that mean? Somebody is selling down here. It's a little bit bearish. That's resistance. All right. The pass back through the opening price increases the odds. They're trying to fill the gap, trying to get to 4,005. If they cannot get there, if they get resistance somewhere in the gap and turn around and start heading back down, that is a gap and go, which is very, very bearish. If they get to yesterday's low and they find resistance there, that is also a gap and go. So don't let this move to try to fill the gap get you bullish. They're just looking for new sellers now that they've run out of those overnight sellers. And they're likely to find them somewhere in this gap. James, when you say the gap, what I'm talking about is the difference from yesterday's low to today's high. So we look at each day, each regular trading hours day, as a range. So from the low of yesterday to the high of today, that is a gap. So we want to try to get today's market into yesterday's range. Then it's filled. You can see the window trader software I use puts this red arrow. That shows the gap. Okay, so first potential resistance is around 39.95, then 4,000. David V, on the tick chart, do you consider the candle's color? I noticed that there are 2 consecutive green candles, but the second is down. No, I don't pay attention to the colors at all, to be totally honest with you. I'm just watching how the ticks move. So where do they start? Where do they go? So if they start down here and they're going higher, that's more and more buyers stepping in. And it's really that simple. As long as it's going up, it's more buyers. If it can get above the 0 line, then the buyers are in control. There's way more buyers than sellers. But if they get slapped back down at any point, that's the signal you're running out of buyers. But I don't pay attention to the color of the candle. McStockster. What's up, dude? Good to see you. So at this point, we've turned the opening price into halfback right here at 39.87. So that should be able to act as support. If they're going to be able to head up and fill the gap, they should be able to hold here at the opening price. If they pass back through the opening price once again to the downside, so we opened, passed down, tried to go lower, couldn't. Passing back through it again, increased the odds we were going to try to fill the gap. Now, if we pass back through it again, it's a gap and go. So we are looking for support here at the halfback, and if it breaks, I get bearish. Thank you, Ross. Appreciate you, brother. There it is. Ladies and gentlemen, we have a gap and go. I am bearish. I now remain bearish as long as we are below yesterday's low. So even if they make another attempt to fill the gap, I will not be looking to go long for that gap fill trade. I will only be looking to sell resistance, as I am now bearish. In my mind, what I believe the market is doing is what I call a look above and fail of the balance area. On our way up from the balance area low to the balance area high, we left a lot of weakness behind. And so in my mind, the market needs to head down and start repairing this weakness. Now, the tricky thing about a balance area is it's very high probability that the market is going to work its way to the balance area low. It is very, very hard to get there. It can take days. The market could slowly rotate lower, little bit by little bit. It could happen in one giant liquidation in like less than an hour. I mean, the market can work its way from one end of balance to the other any way it wants to. And it is notorious for doing so in the most difficult and confusing manner possible. It will all day long make you think it's finding support and going to turn around and head back up, and then it just keeps going lower. So my focus this morning is on momentum and nothing else, right? First sign of momentum, we created a gap. Second sign of momentum, the gap and go, passing back through the opening price. So now I'm bearish. Now I'm only looking to take trades in the direction of the momentum. And I know in the end, I think the market's heading down towards the 39.20s, but I'm just going to see how far they can push it. So this is not a trade to hold the whole way down. This is a sell the rip, buy the dip, sell the rip, buy the dip, way down. Okay? Because it could be a long, arduous journey to get back down there. And again, I hold that opinion even if we fill today's gap. It's only if we get back up into yesterday's range that I change my mind. Charles, how can you be so confident? I'm just using the market-generated information. I'm just looking at what happened the last time. And that's all I'm doing is just figuring maybe what's happened before could happen again. Speaking about that downtrend, look at that perfect bounce. Can they hold it? I think not. Nunez, how will you know if we are indeed going for that gap fill? Like I said, I'm no longer interested in the gap fill. They just tried and they couldn't do it. At this point, I wouldn't even care. So like if the market starts to push back up and it starts, I'm not paying attention to the up. I'm paying attention to the sellers, the resistance. Where do those sellers step in? Because the first time they poked up there, those sellers smacked it right back down. So that means we have momentum from the gap and new sellers, which is more momentum. So how do we know if they are indeed going to fill the gap? Well, the answer is it doesn't really matter. What we want to know now is where do they smack it down? Because the sellers are the ones in control. Chilling with Dylan. The other option is a boring sideways day. Yes, sir. A boring sideways day is possible. But even if it was a boring sideways day, in my opinion, it'll be lower. So even if we were going to do a boring sideways day, it'd be down here. As I think this is where the market is going. I could be wrong if they find support literally right now, but I don't think so. Scooball says, do you think that the weak reference created by icebergs are weaker? I wasn't paying too much attention to it. Weaker than what? I have a feeling most of the weak references that we see are created by icebergs. It's usually the computers that stop it at those exact references. More than a weak reference without it? I don't know. I mean, I haven't really thought about it. Maybe. It would make sense. Scuba. It makes sense. Doesn't mean it's true. Isn't that the story of trading? That's trading in a nutshell. It can make sense. Doesn't mean it's true. Okay, so what's the story that the ticks are telling us? Well, we opened extremely oversold with most of the inventory being net short. We couldn't even get back to the zero line. There were so many sellers waiting, just hungry to get short. We couldn't even get back to the zero line. So that is also a sign of momentum to the downside. First potential support is 39.74. That was the base of the spike up from a few days ago. That would also be where we got a signal of momentum up. So it could just be that that's all they needed to do was backfill to there, and then they're ready to turn around. But not in my opinion, as the momentum will likely be able to break through and repair the weak reference just below. Screwball weaker in terms of a stronger magnet. Yeah, like I said, it's an interesting idea, because as we've talked about, we don't know when somebody puts an iceberg somewhere. This one isn't weak, so it's not a good reference. But let's say that we're a weak reference. We don't know, was that a human, a person who was like, okay, I want to short here and I want to use this exact reference or whatever. We don't really know that. Or if it's a computer algorithm that's running just on a software program that it's been pre-told, do this every day at this time, if this is blah, blah, blah. If it is the mechanical of the two, if it is not human behavior, which is random, but it is instead a pre-designed mechanism, which is built for the purpose of getting liquidity above that level, then it would make sense that is a much more reliable signal because it's not based on the willy-nillys of some human. It's a pre-programmed algorithm that will do the same thing again and again. So it is a very interesting thought. I just have never explored it. Kathy, what's the next support? Like I said, potential support at 74. I think more likely it's going to be at 70 because we've got a weak reference at 73. But we'll have to wait and see. Okay, no support at 74. Okay, there's a repair of the weak reference. So this is where we get into the conversation of, they've got momentum, but do you want to stay in a trade all day long? Or do you want to take profits in support and then sell resistance and ride it on the way down? Or do you just want to get short at the gap and go and hold it all day? Two very different approaches to the market, two very different ways to trade momentum. And days like this will be excellent opportunities to learn which is better for you. John Lash, news at 10. Thank you, sir. Kathy, impact news coming? Well, we'll find out. We're pushing into support. Nunez says, split the trade in two, buy support and sell resistance with one half and ride the second one. No. No. Nunez, no. You don't understand risk. Ross B says, do you drink coffee in the mornings? Yeah, of course. If I don't want to be a zombie. All right, so the market found support. It's weak. It is not good support, but they found it, and they got those ticks back to the zero line. Now, we know the sellers have the momentum, so we're looking for where do they smack the market back down. First potential resistance is going to be the halfback right here at 39.81, and then once again at yesterday's low, 39.84. It is worth noting, remember what I said, they will take the market down in the most difficult way possible, in a way that makes you think they're going to reverse it and take it back up all day long, but then it just keeps going down. Something to consider. James says, wait, what? Trying to figure out how that would work. I'm not sure what you're referring to. Screwball, in days like today, do you place your stop loose at yesterday's low at the moment the price passes through the opening to the lows? So the trade for the gap and go was the pass back through the opening price with a stop above the high that you made beforehand, targeting the first support, which was the repair of that weak reference. As I said at the time, this is a sell the rip buy the dip market, as they will likely make it extremely painful on the way down. We know that's what they like to do on a balance area. James, the splitting of the two. Yeah. Well, no, what he's saying is like, so let's say you don't know if the market's going to find support here, right? He's saying go like long and short, get both contracts. And then like, if it starts to go up, exit half of the short or whatever, and then hold on to the long. And then the idea is like the profits will outweigh the losses or whatever, but it's just the worst possible way you could approach the markets because you could be wrong on both ends. You know what I mean? You can get out of the short up here, then it comes spiking back down, and then you got to get out of the long down here, and you lost double. So the way to trade like that is just get on with less size. If you want to buy support, just only trade with an amount that you're willing to lose. Instead of like, well, I'll get on with full size, but I'll protect half of it with a hedge. Like what? Just smaller size. I can promise everyone out there, if you're looking for a quick fix, if you're looking for a thing you can do that just makes this easy, you're going to spend years and years and years looking and then quit. Don't try to do it the easy way. Do it the hard way. That's the way that works. Buy when everyone else is scared shitless. When everyone else is convinced that the market is going to go, sell. When everyone else is convinced the market's going to go up, that's when you sell. And then you buy when they're all feeling fear and panic at the lows. Oh my God, it's going to keep falling. That's when you buy, and you sell when they're, oh my God, it's going to keep going up. But that's hard. That's the hard thing to do. So Charles, how do you do it then if it's hard? Well, you manage your risk. You make it so if you're going to make a bet down here or you're going to make a bet up here, if you're wrong and you lose, you don't lose an amount of money that hurts you. You lose an amount of money that is acceptable. And you can keep a clear mind and look for the next bet. McStockser, those are rookie numbers. You get those numbers up. I count my gummy bears in handfuls. Gummy bears would have been a better like making fun of term instead of gay bears for Wall Street bets. Gummy bears is so much better. They should have called people gummy bears. All right, back to test the halfback as resistance once again. It did not hold the last time. It was the overnight low that held the last time, but can the resistance hold this time? John asks Charles, why do you base all your analysis on the 30-minute as opposed to the 15 or the 1 hour? It's a fair question. So the person who I learned this form of analysis from is a guy named Jim Dalton. And Jim Dalton has been using the market profile to trade the ES for decades and decades. And he has experimented with all the different time frames. And his conclusion is that the most reliable, the most consistently reliable signal come from the 30-minute TPOs. So the short answer is the guy who taught me does it, so that's what I do. And it's always worked for me. And if it ain't broke, don't fix it. That being said, if you have your own market profile software and you wanted to experiment and try out different TPOs, you wanted to try the hours or the 15 minutes, I would fully encourage that. You might discover something. I just personally like to keep things simple. James, is this your software? No, it's Window Trader. Thank you, Tom. If you look down at the bottom of the description, I've got links to those, to Window Trader, which is the one on the left, the market profile software, and Bookmap, which is the one on the right. And the one hiding in the back is Thinkorswim. But that's just good old internals. You can see them anywhere. And what are they saying? They're saying bear, bear. Bears in control. Nigel, I have NinjaTrader 8. Do you have the settings to translate? Not exactly. NinjaTrader does have market profile software. It's not precisely the same as mine, but it works just as good. All you really need when it comes to the market profile software is you need to be able to see how much time the market spends at a certain level. So you need some sort of TPO, right? That's what on my chart is the letters. Okay, that show you the areas where the market spends the most time. You need that. It can be anything. Some different softwares use letters. Some use like symbols, like little circles or little squares or whatever. It can be anything. But you need some sort of way to see the levels, price-wise, where the market spends the most time. And you need to be able to see the levels where the market brings in the most volume. Beyond that, everything else is just bells and whistles. Everything else is just makes it look pretty. The truth is, all you need to know is where does the market spend the most time and bring in the most volume. And pretty much any market profile software will do that. And not pretty much, literally any that's what market profile software is. James, the links are in the description for the YouTube video. Scroll on down. While you're there, sign up for the e-course. Join the brigade. Infinity, NQ. Let's take a look. Oh, my goodness. Oh, wow. So you got a big gap on the Q. That is bearish. Bigger picture, you're re-entering a previous balance area right now. You're literally kind of just bouncing around right on the top of that. So that would be like this major node right here around 11,590 to 11,650. So that node right there, that's sort of the top of this previous balance. Okay. And so that's what you're kind of fighting your way into right now. If you start to dip below there, you start to dip, pretty much below what's the current lows, you're heading back down, same as the ES, towards the opposite end of your balance. That's pretty bearish. It is also worth noting, obviously it's too late to bring it up now. It's too late, baby, they can't learn now. You should have told them sooner. Gaps this large often don't fill on the first day. So anytime you see a gap that's this large, there's just a slightly higher probability that it will be a gap and go. And it looks like here on the Q, they didn't even pass back through the opening price ever. So they opened, they passed through the opening price, and then they only ever got resistance at the overnight low. So this one should have been screaming at you to short pretty much all day. Gap that's so large, it has a lower probability of filling and no attempt whatsoever to try to fill it. That's just so much momentum. So now we've got, I mean, we're looking at the Q here. We've got the value pushing up against the low of the day. That increases the odds that we need more excess to the downside. If we get that C period to dip down there below the B period low, that is the beginning of a trend to the downside. And from that point on, we can just watch the highs from each TPO. And as long as the market continues to make lower highs, we can just assume the market's going to keep going lower until one of those highs comes above the previous TPO. Okay, the previous 30-minute time period. That doesn't count right now because we're still inside the initial balance. But once we break the low, that comes into play. Looking at the ES here, we are once again testing resistance at the halfback and the overnight low. If we pass back through the opening price now, I will no longer be bearish. I will be neutral, looking for the gap fill. But that to me is less likely. I think the higher probability is resistance and continuation lower. It is worth noting, I say it every time, sometimes people listen, sometimes they don't. So I'll just say it once more and leave it in you guys' court to keep in mind that when the market is working its way from one end of balance to the other, it will often do it in a very confusing manner. I can tell you, these days here, there was lots of people convinced the market was going to go down, but yet it just kept ending higher every day. It just kept doing it. Same thing here on the way down. The whole way they were convinced it's going to reverse and go back up, but it just kept going lower. It happened here too. This one was like a holy shit. We couldn't believe it. It had such a huge break, but then it just kept going lower. So, keep the balance in mind. You don't know what the journey to the opposite end is going to be like. It may drop like a brick all at once. It may slow grind. It might make you think it's going to reverse 100 times. But you just know the highest probability is where it's going to end up. And so you don't need to worry about those things. You don't need to worry about, is it going to find support in reverse? That's not the question. The question is there going to be more sellers to keep it going? Only when you can answer that question with no. Only when you can say, nope, there's no sellers. They've pushed it as far as they can push it. Only then do you begin to ask questions, can it bounce? Otherwise, you will have an edge in your approach if you are focused on looking for the resistance to take the market lower, rather than looking for the support that is the bottom and reverse. Don't worry about catching the bottom. There'll be plenty of profits on the way up if you let the market make its own bottom and then give you the signal. Prior to it doing that, the highest probability is the opposite end of balance. With that, I will say goodbye. If you're a member of the brigade, if you're one of the cool kids, well, then let's head on over to the private stream and we'll hang out there and we'll watch this sucker grind lower together. If not, we'll see you here tomorrow. Thank you very much.